Hello, and welcome back to the Wright Research Podcast. Today's video is all about quantitative trading or investing. I am Sunam Srivastava, the founder of Wright Research, which is a quant-driven investment advisor in the India market. And I've been a quant trader for more than 30 years. Now, whenever I go and talk about Wright Research to the Indian investors, the first question they ask me is, what exactly do you mean by quant trading? What is the benefit of quant trading for the everyday investor? And how is a quant investor different from a traditional investor? So in this video, we're going to talk about all these points and explain the word of quant investing to you. Before we go and start talking about quantitative investing or trading, let's first understand what a traditional investor or trader is. A trader in the financial market is simply somebody who makes transaction in the financial instruments for himself or on behalf of an institution. They can be following instructions or they can be taking short-term trades to take advantage of inefficiencies in the market and make a profit. An investor, on the other hand, is slightly different from a trader. They are taking bets or taking ownership in stocks so that they can take advantage of the appreciation of a company's value in the long term. Right? So they are long term, they have a longer horizon than a short term trading. But how do people become traders and investors in the normal sense? So if you follow any of the famous traders and investors in India or on YouTube, you would see that people rely a lot on their intuition, right? And their experience. So they have burned their hands a lot in investing, they've experimented a lot in the financial markets. And now they sort of have developed an instinct through which they trade, right? So their power is their instinct that they have also learned maybe through some mentors, being part of some trading groups, through internet, or even through internet forums and YouTube, right? So a traditional trader or investor works primarily through his instinct. A quant trader, on the other hand, is very different in that sense. So a quant trader like me does not rely on my intuition, right? My intuition in the market helps me in my research, but I do not trade trades based on my intuition. A systematic or a quantitative trader, on the other hand, relies on data-driven analysis of the market to take their decision. So we are not relying on intuition. And what we are doing is we are devising a game plan based on our analysis of the market, and we are allowing a computer to take the trades on our behalf, right? And we will not override those trades that the computer takes because we trust the system that we have built. So that is quite distinctly the difference between a traditional and a quantitative investing. Now, let's say I have an idea that I want to do a paired trade between Nifty and Bank Nifty. I think that Nifty and Bank Nifty move together. And when Nifty has moved a lot and Bank Nifty has not moved, then Nifty is going to come down and match the level of Bank Nifty. The ratio is going to be 19. I can have this hypothesis. But before I start taking trades on this idea, what I would do is I would collect historical data. I would see how their spread moves. What I am thinking, does it actually work in the market? And even though it works, right, how do I participate? At what spread should I take my trade? And, what will be profitable based on the historical data? That is how, as a quant trader, I would, take up this problem of pair trading. On the other hand, as an investor, let's say, I have an idea that I want to invest into an IPO. So I would not just go and, buy any IPO that comes in or, buy any IPO that's getting a lot of news. What I would do is I would collect the data of historical IPOs, see how they historically perform, what role does a market condition have in governing how the IPO is moving, and what other factors they influence the market, and how I can devise a strategy that helps me invest into company. Similarly, for stock picking, even for the long term, right? Let's say I want to do value-based stock picking. So what I would do is I would try to find out what are the best value strategies out there in the market. How do I determine any stock has good value into it, and what is the best way to participate into it? And then how do I create a diversified basket of value stocks? Similarly, if I want to invest into trend, I would again test my hypothesis of capturing trend based on previous data and devise a strategy of investing into it. So my way of investing would be very, very different from a instinctive trader, right? Who has an instinct that he has built and, honed with experience. I would more rely on analysis and, the system that I have. And, when making all these decisions, there are various, important things that you have to think about. One could be, what is the duration of my trade? When do I cut my losses? When do I think that, I have made enough profit to cut my trade? So all of these ideas, all of your parameters can be testable, right? And that's what we do, right? So instead of, letting instinct govern anything, we test out any ideas that we might have. We play with the parameters, analyze vast amount of data before we bring out any trade to you. Now, before we move on to understand what are the skill sets that you would need to become a quant trader, I think the most important point to note here is that a quant trader, much like any traditional investor, maintains a healthy level of skepticism in their in trading, right? So I think any successful investor has a high level of skepticism or self-doubt, which they work with, right? So as a trader, if you think that your trade is going to work 100% of the time, then, I have a bad news for you. That does never happens in fact, right? So even for a quant trader, nothing will work all the time, right? And even something that has been doing very well for some time can stop working as the times change. So as a quant trader, my job is not just to make a system and, let it run. I have to be on the lookout to constantly understand what is going to invalidate my hypothesis. If I am working with any idea, what changes in the market can make that idea not work. And, if that idea is not working, then what is working and how I can pivot my strategy to keep on continuing making profit in the market. Similarly, because quant traders are letting a system run, right, without, our instinct to safeguard the capital or safeguard the risk being present all the time, we have to maintain a healthy level of risk management. So if you look at a quant trading strategy in the market, what you would typically see is that a quant strategy typically never buys an option or just sells an option. They work with hedged option strategies. They will go with a straddle or a straddle so that you are never taking a naked risk in the market, right? You are always hedged. Because the quant trader knows that, the trade is on the discretion of the computer after I create the strategy, I have to make sure that I'm hedging my risk. Similarly, for a quantitative investing strategy, right, you would see that a quant strategy is typically very well diversified. We are never taking a risk on, 2, 3, 4, 5 stocks that we think are very good. We would typically create a basket of, 20 odd stocks, which are well diversified stocks from different sectors, different industries, different factors in that, which we think, together will give you a good risk adjusted returns and, they will safeguard you from the risk as well. So, no quant or, no actual trader, human or machine can be 100% correct all the time. The market is very vast and diverse. And the only tool that, we have in our hand is risk management that quant traders focus on. Now let's understand what are the skill sets that you need to become a quant trader or an investor, right? So I think, mathematics and understanding numbers and statistics is the most important skill set, right? If you're going to take a decision based on numbers, based on a distribution of numbers that you see all the time, obviously you need to understand how numbers behave, their statistical distributions, and maybe some probability theory, etc. So numerical skills are extremely important. But, if you are an amazing mathematician, that does not make it true that you're going to be an amazing trader. Understanding financial instruments, understanding corporate finance, understanding, the word of finance, I think is one of the most key important things that you also need to know before you can become a quant trader, right? If I can, create a hypothesis and if I can create a system that in the real world does not work, right? Like maybe I have created a system that, does not account for transaction costs, right? Any broking cost that I'm taking. Or I have created a system that, does not fit into the various regulations that are out there in the market. Then obviously that system is not going to work. So understanding the financial market, understanding the base instrument, understanding, the nitty-gritties of it is also extremely important, as much as the mathematical knowledge is when you are trying to become a quantitative investor. Now let's understand how does a quant trader work, right? So I think a quant trader works in, a very, very similar fashion in what a traditional or a discretionary trader would work, right? So, all of us have an idea, right? Or an instinct or a hypothesis. And then we start working on it. So let's say you have an idea that, right now investing based on trends will work really well, right? If I can pick up stocks that have high momentum, that's going to work really well. So a traditional or discretionary investor, what they would have is, they might have their own instincts. They would look at chart patterns, so, they might understand fundamental rationales for the trend and start investing based on it, right? So their instinct would be built somewhere in the complex algorithm of their brain and helps them pick all those, trending stocks. On the other hand, a quant trader would also have the same hypothesis, right? I would also have the same hypothesis that I want to invest into these trends. But instead of trusting, my instinct to do this, what I would do is I would try to analyze historical data, look at statistical patterns, try to validate my hypothesis, try to find out the best way to work with this hypothesis if it actually works. And then I would use that system that I've created to invest and, invest in that fashion. So, whereas all of us are trying to do the same, we all have picked up a opportunity or a hypothesis that we think are exciting. While a traditional discretionary trader trusts its gut or trusts its instinct to drink, a quant investor typically analyzes that instinct based on a number of data points and, create a system that trades on its behalf. Now, for me to, trade as a quant in a given market, what are the requirements that, that I have to follow? So I am trying to invest into patterns that are replicable, the patterns that will repeat in the market, right? And patterns will only repeat in a market that is liquid and large, right? So a large cap stock might, follow a replicable pattern time over time, whereas a small cap stock is very, very unreliable, right? A very small stock is governed by, very small stakeholders, maybe, news flows that can be very sudden and can have huge impact. So for me to invest into, securities, I would require a large and liquid market. So maybe, large and mid cap stocks, probably, futures and options, and a very, very liquid market. Because, I'm working with numbers and I'm relying on numbers to work for me, I cannot work in a market where sudden information can sort of disrupt the whole. And, talking about, large markets, we have to prioritize, let's say, we have to focus on stocks that have high liquidity. And also, quant traders are typically more tactical than a traditional investor. Traditional investor, typically tends to buy and hold any stock for a very, very long time, whereas we as quant investors can be a little tactical. I might have taken a bet on a stock, but after a few months or, some time, I realize that it's not working for me. I cut my losses and I move on to my next idea. So I'm trading much more frequent. So the transaction costs, right, or cost of trading are going to have impact on me. And when costs are going to have an impact on me, I need that the transaction cost to be lower. That's why, you would see a lot of quant traders going to discount brokers and, practicing their trading there. So, so these key points like liquidity and cost are also very important for you to know when you're going to become a quant trader. And, using data analysis, using technology to work with this cost and control your positions, manage your risk is extremely important because you're relying on a system to take trades for you. You have to build in all these fail-safe mechanisms in your system before you can deploy it into the market. Now, a big problem for a quant investor like me is that even though people are aware about quant investing, they have their own myths, due to which they don't trust quant investing. So I think one of the most important myths that people have is that quant investing is a black box. There is no transparency. So, it's like a black box taking decision for me, so I cannot trust it with my money. But if you actually go into it and try to understand it in depth, you will see that, as a quant investor, when I talk about any investing decision that I have taken, I will talk about the various factors that go into it. I will explain that trade to you based on the system that I have built, and it will be very, very explainable. On the other hand, a traditional investor typically works with his gut, and so that is more unexplainable than a system that's working. That's one myth that we need to bust here. That quant investors are not black boxes; they are extremely transparent. They can actually help you understand that trading decision making process better. Another myth that people have is that quant investing is very complex, right? It only an expert can sort of do. So, like I said, that there are various things that you have to make sure that you understand before you start investing, right? You have to know how to risk manage. You have to understand the constraints in terms of liquidity, in terms of transaction cost. Because if you don't do that, you're going to suffer, right? You're going to face those losses. So, there are certain aspects of it that you want to understand. You have to understand financial instruments and financial markets. And if you don't understand that, how can you work in this market, right? So there are very key things that you need to understand. But it's not a requirement that only a expert or a PhD can do quant trading. Anybody who diligently learns the basic knowledge about the various aspects into trading and markets can try their hands at quant trading. And the third myth that people have is a quant trader does not look at fundamentals. These are technical trading, which is again a big myth. So a quant trader looks at numbers. So that the data coming from the balance sheet, the data coming from even the news flow, the data coming even from the sentiment of people can be put out as numbers, right? So a quant trader can look at fundamentals, can look at trend, input, and look at any other factor that is out there in terms of numbers. Quant traders can be fundamental traders as well. People also think that a quant strategy once made cannot adapt to a changing market condition, right? Market shift, then that strategy is going to fail. But what we have to understand is that a quant trader typically, like a person making quant strategy is aware that market shifts its behavior time to time. And they and tactical nature and adaptability is the key thing that is built into most of the quant strategies. And you will see a quant strategy being much more adaptable than a traditional investor. And now another big myth is that, quant will not work, quant does not perform well. Quant is something that we've heard, but it can never beat a human being. Now, to answer you here, you can look at what Wright Research has done. We've been there in the market for the past 4 years. We have done tremendously well, but don't look at us. Look at a number of other examples that we have across history. You have Jim Simmons of the NASA Capital. You have AQR. You have so many. You have T-Short. You have so many different examples in the market where quantitative traders and hedge fund managers have consistently beaten the market by a huge margin over decades, right? So obviously, quant traders do work. There will be like any field where you are trying to do anything, you will see failures and you will see successes. But success in quant trading actually does exist, and it's quite demonstrable. Looking at the examples I talked about. Now, I'm not going to come and tell you that a quant investor is better than a traditional investor. While you have a successful quant investor like Jim Simons that you can look at, on the other hand, Warren Buffett is a traditional investor, right? So you can never say that, which one is better. But obviously, there are various ways through which quant investing can provide an edge to your own investing in trading. The first way in which quant trading can provide an edge to you is that it is data-driven, right? So we are looking at rigorously testing a lot of data to identify patterns to trade based on, right? Which is something that a traditional investor, even though they might have good instincts, can miss. If you can have a very good quant system with a lot of good analysis built in, you can add an edge over a traditional investor. Second is that, as a quant investor, I am systematic and disciplined, right? I will never my emotions are not going to take over. As a traditional investors, I can have a number of biases. I can get overconfident, right? Or I can, be married to a particular idea, or I can, uh, start herding towards what I am seeing a lot in the market. Right? So a traditional investor can have a lot of these biases that can bar his decision making, whereas a quant investor follow a systematic approach that will do what is coded to do without, having any such emotion sway its decision making. Now, the third advantage that you can have is that, your speed of analysis and your speed of processing can be very fast. You can have computers working for you. You can run analysis very quickly, whereas, as a traditional investor, who wants to take a good trade, will have to study this and look at a number of ideas and maybe experiment on it for a long time. As a quant investors, I can run my analysis in a fast-paced computer, maybe quickly come up with uh, a strategy or a trade that can be of advantage for us, right? Now, the fourth advantage for quant investing, which a traditional investor can also have, is that, you can have very strong risk management and diversification tools. You can use quant methods to enhance your risk management, enhance your risk diversification, and do a lot of interesting work in reducing the risk of the system. And like I said, quant investors, quant trading methods can be highly dynamic and adaptable, which is something traditional investor typically tends to not tends to not be as adaptable as the quant investor can. A quant investor can also be very scalable and consistent, right? So I can run my ads on 10 stocks, 100 stocks, 1,000 stocks, or 4,000 stocks. There's no end to the number of stocks that I can analyze, right? Because at the end, it's the system doing it. Similarly, there's no end to the data points that I can look at, right? So, I can look at the momentum indicator, the value indicator, the growth indicator, any data that I can get my hands on, right? So I'm not, so I can access and work with, scale it up to as much data as we want. Similarly, because I'm following a system, I can be consistent. But I can expect what the system is going to do in any given market condition. Obviously, your performance will depend on what the market so that right? So I will not say that the quant system is going to be consistent all the time. At least it will be predictable, right? I know that if there's a risk in the market, I know that my system will behave this way. If there is risk, it will start reducing the risk, it will reduce exposure to high volatility stock, and still it will might say volatility, right? So it is much more predictable and much more consistent in our understanding, if not in terms of performance. Now, as a quant investor, I can have a consistent, continuous process of improvement and backtesting, looking at more data points, looking at what's not working, what has stopped working, and what I need to improve to build a better system. Continuous improvement, backtesting, and continuous, work on the strategy is something that the quant investor can always do. So this was my brief and simple effort to explain quant investing to you, to demonstrate, how quant methods can also help you become a good investor. Not saying that traditional methods cannot make you a good investor, but quant methods can also be extremely helpful and extremely instrumental in making you a better investor. I hope you enjoyed the video. And if you want us to make more videos like this, explore more quant concepts, maybe certain quant strategies, please do write that in the comment. Let us know what you would like to hear more from us. And please do subscribe and like this video. See you in the next one.